I've never seen myself as just one thing, and I made sure no one else could either. By staying true to myself, making my own path, rising above expectations, and opening the door for others to be their true selves. The first spirit, made with VSOP Cognac, finished in bourbon casks, Martell Blue Swift, soar beyond the expected.
Good afternoon, good evening, and good night. I am Illuminati, and this is the Crypto and Cognac podcast show, as always, coming to you live every Thursday, 7 p.m. sharp. I see my boy Steven is quick. He's on board. Steven, do you have your drink? As always, I'm fueled by my guys at Martell Cognac and Massy Connoisseur. Opening a new bottle. It's a good week. I mean, BTC is up. The markets are up. Well, compared to last month, compared to last year. So we're taking that, we're enjoying it. This evening, guys, I'm very, very excited to be talking to you guys about something that I've had the pleasure of learning. Sometimes it feels like way too much about in the last couple months, in the last couple, I could say years as well. But something that for me was a little interesting, this particular occurrence, right? And that's to talk to you a little bit about the BIS, the Bank of International Settlements, and their recently published standards for central banks custodying cryptocurrencies. And why I say that has been a little bit, I guess, interesting, is that in the past few years, the BIS has shown quite a level of disdain towards, cryptocurrencies. And they'd spend the last few months, the last year or so, kind of advocating for central banks to and supporting central banks in the creation of their own CBDCs, central bank digital currencies. So for you guys who are regulars, we've had this conversation about CBDCs before. If you're new, you could go back and rewatch one of those particular episodes. Maybe we'll put a link down in the description after this particular conversation. Yes, sir. The Bank of International Settlements, or the central bank's bank, right? So I thought it would be very prudent and necessary today to start by giving some history, some context about who the BIS, the Bank of International Settlements, actually are. And basically, this is an organization that was established in 1930, and it is actually the oldest international financial institution, right? Now, there are older financial institutions, but they are all kind of locally based in different jurisdictions. Now, it has played a key role in the global economy since its inception, from settling reparation payments imposed on Germany following the First World War to serving central banks in their pursuits of monetary policy and financial stability. They were actually involved in helping central banks secure their goal during the Second World War, European central banks, that is, by moving that goal to the US. The BIS is technically, it's privately owned. It's owned by 63 different central banks, and these central banks represent countries that together account for 95% of the global GDP, right? So it's all the biggest central banks and the countries that they represent. They are the owners of the Bank of International Settlement. It is currently headquartered in Basel, Switzerland. Basel, I don't know. You say tomato, I say tomato. Interestingly enough, though, because we always talk from the Caribbean perspective here. Interestingly enough, of the 11 regional central banks in the Caribbean, none of them are members of the BIS. Also, in terms of African central banks, there are only 2 African central banks who are actual members of the BIS, and that is the Bank of Algeria and the South African Reserve Bank. So even though the BIS represents a significant amount of global capital and GDP, they, however, do not represent the whole world, but they do, the standards that they set do impact and affect how central banks who are even outside of their membership would make decisions, right? Yeah, yeah, Stephen, I see you correcting yourself there. So, I mean, I just wanted to kind of touch base because, I mean, we always talk about the Caribbean. We talk about the fact that the Caribbean is made up of 26 different countries, 13 different currencies. But what's interesting is that the Caribbean only has 11 central banks. So we have the Aruba Central Bank, we have the Bahamas Central Bank, we have the Barbados Central Bank, we have Belize, we have the Eastern Caribbean Central Bank, which represents a few different countries. We have Bank of Guyana, we have the Haitian Central Bank, we have Bank of Jamaica, we have the Netherlands Antilles has their own central bank, we have Suriname, and of course we have the CBTT, the Central Bank of Trinidad and Tobago. So what does all of this have to do with anything, right? Who is the BIS? What is their role? How is this have any impact on cryptocurrency and the adoption of cryptocurrency? So recently, as recent as last year, June, the BIS was approached by certain institutions, certain stakeholders who asked them to have a collaborative approach to making a decision as to whether or not central banks will ultimately be allowed to custody cryptocurrencies on their balance sheet, right? A lot of people in this space have been talking about this for a long time, saying that eventually we're going to see countries custodying cryptocurrency. We're going to see sovereign wealth funds custodying it, and we're going to see central banks. So this is just, one step. A lot of people are like, check, told you. But not to get too excited, even though they've released this new standard for how central banks should go about custodying cryptocurrencies or crypto assets, nothing in the standard will be implemented until the year 2025. So we just started 2023. We have another 2 years before any of these conditions, any of these standards are implemented, right? And again, it seems like a bit of a 180 turn, considering that these guys have consistently shown their support primarily for CBDCs. Now, again, we have talked about CBDCs. I personally believe that CBDCs have a role to play in terms of global crypto adoption. I think where myself and a lot of people in this space have fears is the fact that, the despotic potential of CBDCs, the way that they can be used to manipulate and further control our lives. So some of the things people are very, very afraid of is that, central bank digital currencies will allow for the government to be able to cut off people from their money much easier, impose and collect new taxes as they see fit. Even the potential for, putting expiration dates on when you can use your currency by, when you can use your money by, forcing you to spend and prohibiting your ability to save. So with all of that, we kind of keeping two eyes and two hands on CBDCs and how those things evolve. But like I said, it was very interesting to see that the BIS has seemingly changed its position, or at least on the surface, changed its position on cryptocurrency, especially as it relates to central banks custodying cryptocurrencies. I'll talk a little bit more later about why that potentially happened, some of the things that we have to consider, and some of the things that I am a little bit worried about in terms of as they start making those steps. But again, this wasn't just them having a come to Jesus moment and deciding that, you know what, this is the best way for it to be done. They were basically influenced by institutions, by stakeholders. And when we start talking institutions and stakeholders, we're basically talking about lobbyists, right? So people with the money decided that they had an interest in this particular thing, and they decided they were gonna encourage the BIS to change their position. Now, the document in question is called the Prudential Treatment of Cryptoasset Exposure, and it was authored by the Basel Committee on Banking Supervision. Now, the structure of the standard, let me get a drink here, sorry. Now, the structure of the standard has 6 main components, right? It speaks to Group 1 cryptos, Group 2 cryptos, infrastructure risk, redemption risk, Group 2 limits, and a broader category of other elements. And basically, Group 1 cryptos speaks to basically any token that is comparable with or used to represent real world assets. For example, stocks, so synthetic stocks that are tokenized would fall into the category of Group 1A, and Group 1B are basically centralized stablecoins. They did make it a point to note that algorithmic stablecoins do not apply in this particular consideration, right? Shout out to Tilly, Stephen. Yeah. They make sure to shut down the USTs of the world. They're not trying to have a central bank be affected by, you know, what we saw happen with the Luna collapse of 2022. Imagine we saying, you know, last year now, as it relates to Luna. Now, in terms of Group 2 cryptos, they fall into 2 categories as well. Group 2A are basically any tokens that does not represent a real world asset or are unbacked by real world assets, and that would be tokens like BTC, Ethereum, Sol on the Solana network, Matic, you know, all of those. And 2B would basically be smaller cap. So 2A basically would the tokens that would fall into that category would be basically those that are in the top 10, because there are some like market cap requirements and volume traded requirements for making it into that 2A. So I think it's 10 billion in total market cap and 50 million in terms of daily volume to be considered. Now, why that's actually interesting, I was watching a program where they were talking about, you know, this particular categorization, and you know, they were making the point that if that was applied today, we could possibly see some central banks holding Dogecoin, which, I mean, and this is where I need to say, guys, nothing that I share here tonight or any other night should be misconstrued as financial advice, right? I'm not telling you to go and buy no Doge, to buy no Doge, right? But if we look at the requirements strictly, Dogecoin currently falls into that particular grouping for the 2A cryptos, right? Now, infrastructure risk. in addition to the risk associated with cryptos in general and the tokens themselves, the BIS decided to take a look at infrastructural risk, meaning risk associated with the network on which a particular token is traded, right? So if we're looking at the same exact token, for example, USDC as a stable coin, there will be an additional risk attributed to USDC on Solana as compared to USDC on Ethereum, because Ethereum is right now perceived and most likely to be a more secure network. A lot of people would make knocks on Solana and say, you know, Solana goes down. We've not seen it go down recently, withstanding a lot of pressure in terms of volume and activity over the last couple months. So maybe that's a good sign. But this is something that the BIS will be looking at as they determine. So in addition to the risk associated with the particular token, so in addition to the risk associated with USDC, they're going to look at the different networks that it's on. So USDC on Solana will have one associated risk. USDC on Ethereum is going to have another associated risk. USDC on Binance Smart Chain, USDC on Chronos, right? Now, what's interesting about this particular risk, initially the BIS had intended to roll out a fixed rate of 2.5% of the value of the tokenized asset as a metric for calculating that infrastructure risk. However, these stakeholders got into the ear of the BIS and got them to change their perspective on that. And what they've done now is basically just have it as an add-on basis, and which means that each central bank will have the ability to assess on their own the potential infrastructure risk associated with any particular token, and then the BIS will, then make a commentary on what that additional rate should look like. But we all know that it won't be the central banks necessarily. It most likely will be the governments. This is where I have a little concern, because it means that for the particular networks that may have the financial wherewithal to influence or lobby governments, they may have preferential treatment in these types of instances. We all know what happened with SBF and FTX and their lobbying efforts in the US government. And with that kind of subjectivity, I think it's very, very possible that we could see it not being assessed fairly, and it's very, and for me, that's one of the dangerous parts of something that is left to be as subjective as this. Now, as it relates to the next particular area of the standard, the next component we touched on, redemption risk. This basically speaks more to like centralized stable coins. These centralized stable coins have to be sufficiently regulated, and they also needs to be a test done as to whether or not they can redeem the necessary withdrawals when requested. Now, going back to the algorithmic stable coins and why they may not have been considered, we saw that with significant sell pressure on these algorithmic stable coins forces them to lose their pegs, and that could put people in trouble. But even stable coins that are one-to-one backed with fiat currencies or other assets, there still remains the opportunity for them to lose their pegs. We do see the fluctuation sometimes. One USDC might be 1.001 or it might be 0.999998. So I think that's one of the things that I guess they will have to clarify as they go forward. In addition to that, the fiat currencies that these tokens are backed by, they tend to be fluctuating in terms of when pressure is put on them as it relates to redemptions as well. We saw this happen in late last year with the pound, where a lot of pension funds were redeeming government securities, government bonds, and that put some sell pressure on the pound. The pound lost its long time kind of peg to the US dollar, lost its strength against the US dollar. For a short period of time, it was actually less than a US dollar. So I would love to see, how they choose to go about continuing to manage that. And then as it relates to crypto group 2 crypto limits, central banks, members of the BIS, will be allowed to hold cryptocurrencies, group 2 cryptocurrencies, up to a limit of no more than 2% of their balance sheet. Now, that sounds like a small amount, but remember I told you all before that these 63 members of the BIS represent 95% of global GDP. And Bitcoin Magazine, who I'm not very happy with lately, they assess that 2% of the balance sheet of these BIS members amounts to about $3.6 trillion in value. So right now, I think the entire crypto market cap is still under $1 trillion. So if $3.6 trillion happen to come into the market, just think about what that looks like, what that will look like in terms of price action around these particular tokens. And again, we've already established that this is mainly going to be the top 10 cryptos, maybe excluding stablecoins, because stablecoins are in another grouping. So imagine the top 10 pure cryptocurrencies having access to $3.6 trillion worth of value. And this is just from central banks. Not saying that is going to happen. I'm sure that most central banks are going to start with, point something percent and see how it goes. And we may not see it get to that type of capacity for, 5-10 years, maybe even longer. But just think about what that price action does or is going to do for the price of cryptocurrencies. Again, not financial advice, right? And as it relates to the other elements, now that is where they spoke about crypto leverage, where they spoke about the responsibilities of the different central banks in terms of making disclosures to the BIS on their holdings. Yeah, 2% for these central banks is a small amount, but you're not going to start off a new risk asset class by going gung-ho, What is interesting is that the BIS initially wanted a 1% limit, right? And some of their stakeholders wanted as high as 5%. So 2% was really a compromise. So we never know. Maybe in 5 years, 10 years, maybe a couple of years into this program, we might see them readjust it. Maybe they might readjust it downwards. Maybe they might readjust it upwards to the initially asked for 5%. So it leaves a lot of wiggle room for us to figure out what ultimately is going to happen with this. Now, what they're going to be doing from 2025 is basically watching how the implementation of the crypto custody standard is rolled out. And they have also said that they are open to making adjustments to the crypto custody standard as the crypto industry evolves and matures. So all of that, does sound very, very, very hopeful. Now, areas of the standard that they'll be keeping a close eye on is the statistical redemption risk, as we talked about before, looking very closely at permissionless blockchains, looking at group one crypto collateral, so again, stable coins, looking at how these centralized stablecoin issuers collateralize their stable coins and how that is impacted when there are redemptions. Again, they're going to be reassessing the group 2 criteria, how they decide which tokens qualify for that group 2 criteria, who do not qualify, and they're also going to be, again, looking at the group 2 limits. Now, what we have to really ask ourselves, outside the influence of these stakeholders and these lobbyists and these institutions, what was potentially the biggest reason for the BIS, the Bank of International Settlement, changing their position on central banks being able to custody cryptocurrencies? Now, I, for one, think that over the last couple of years, as many central banks across the world have been investigating the issuance of their own CBDCs, I think it would have been discovered that not every central bank has the capacity to issue their own CBDC, or it may not be prudent for them to issue their own CBDC. And I see this being more of a testing ground to see how approved stablecoins can operate as maybe synthetic CBDCs. Because I think one of the main requirements for these CBDCs is that they're going to need to be backed by the fiat currency in the territory in which they're registered. So if they're registered in the US, they're going to have to be backed by US dollars. If they're registered in the UK, they're going to have to be backed by pounds. If they're registered in Europe, they're going to have to be backed by the euro, and so on and so forth. Stablecoin issuers registered in Trinidad and Tobago going to have to be backed by TT dollars. So I think this is a testing ground to see how these stablecoins could potentially operate as synthetic CBDCs to help some of the smaller central banks be able to take advantage of the opportunities that are present with CBDCs. Now, we talked about the fact that none of the Caribbean central banks are members of the BIS, but we do know that here in the Caribbean, our governments, our institutions, our banks, our private companies look to see what's done in bigger territories in the first world, and then adopt their strategies based on what they see happening there. I could see a lot of these regional central banks now feeling a lot more comfortable to start taking a closer look at crypto assets because the BIS has now issued these standards. We might see them actually mimicking these standards set out by the BIS, because I could see our smaller central banks falling into the category of central banks who may not be in a position to issue their own CBDC. So it might be just easier for them to adopt the standard, adopt a stable coin, maybe a stable coin backed by, I personally believe that a stable coin backed by a regional currency is just a matter of time before it happens. I think it's going to be necessary. I've been saying that the government of Trinidad and Tobago should be looking very closely at it, because what I think it does is help alleviate a lot of the challenges that we experience here in Trinidad and Tobago in terms of access to foreign exchange, in terms of creating demand for currency outside of Trinidad and Tobago. So, you know, I see that as being something that is going to hit our airwaves in a short time. As it relates to Caribbean central banks as well, we know one or two of them have been testing their CBDCs, Jamaica with their Jamdex, Bahamas with the Sand Dollar, and the ECB, the Eastern Caribbean Central Bank with Dash, is it Dash, eDash or something like that? Sorry. But yeah, I think it's definitely a necessary evil. But I think we absolutely have to be very, very careful of how it happens. I mean, we have 2 years to see these standards be adopted. We have some time to dissect the document. I mean, the document is heavy and technical. So I went through the document. I went through it. I looked at other people who assessed the document, and yeah, it was still a lot. So if you might be more technical than I am, you know, feel free. DYOR, do your own research, is what we always advocate for. We're gonna leave a link in the status below where you could go and see the document yourself, go through it. There are a few graphs in there as well that may help you with your understanding of it. Yeah. And that's basically it. I mean, I just wanted to give you guys some context for something that I think is going to start popping into the mainstream dialogue a little bit more, as you know, mainstream media picks up the fact that, you know, the BIS have cleared the way for central banks to adopt crypto assets. You know, we're talking about the US Fed, we're talking about Bank of England, and all the big name ones. So exciting times ahead for all you crypto curious, or, you know, people who are fully engaged in this space. So guys, if you don't have any questions, that's it for me for tonight. I mean, Stephen is the only one who really been engaging with me. So as long as Stephen don't have any questions, I guess that's it. As I always say, guys, adoption is inevitable. Thank you for being with me. Love having these one-on-one conversations. I look forward to seeing you next week when we have an exciting conversation. We're going to have a guest on. Can't tell you who it is just yet, but we never have dull conversations. So I look forward to seeing you guys. As always, be blessed. Illuminati out.